Hey everyone, thanks for joining today's video. In the stock market today, we have two stocks that are flying after reporting really strong earnings reports. We're going to go through both of those stocks. They are AT&T and Netflix. So we're going to start here with AT&T and then we're going to move over to Netflix. I'll put a timestamp in if you prefer starting with Netflix, but we're just going to get right into this one. AT&T reported their earnings today, and we can see this company has had a bit of a rough go. Year to date, still down 18%. Longer term, still not doing very good. You can see they've dropped pretty dramatically in the last number of years. Couple sound bites though to sound on top of this. They have been paying a really high dividend, current yield of over 7%. It was actually even higher than that prior before they did some reorganizations. And the second thing is they did divest Warner Brothers to partner with Warner Brothers Discovery. So some shareholders did get value from that divestiture too. So it's not really a 38% loss over the next 5 years or the last 5 years. But nonetheless, they have not been performing very well, which makes this very pleasant news today for investors, up 7.5%. Company's currently trading at $110 billion market cap, and we're just going to jump into their results and why the stock is jumping to this extent today. We're going to start off just high level, highlighting their three business priorities that they've kind of been calling out throughout the year, and they reiterated them on their call today. The first one was 5G, everything around 5G, implementing 5G, investing in 5G, building customer relationships on 5G has been focal to their growth strategy, just because 5G is seen in the telecom space as one, first of all, where all the capex have been going, but that's because it's been the potential next wave of growth for these companies. Who knows what some of the applications of 5G will bring. When we go back and look at 3G and 4G, we saw tons of exponential business growth opportunities come from these increases in technology and innovation. So this is a really important thing for the company to make sure they're at the forefront of, so they can capitalize and expand revenue in those relationships with consumers behind 5G. They're still in the building out phase of it though. The second one is essentially just efficiencies. They are a company that has a lot of debt, does not necessarily have a roaring revenue top line. So becoming more and more efficient, achieving incremental cost savings across their network, using AI to improve processes, all of that stuff, while it's not overly sexy for a investor to hear about in terms of not like a new business opening up or not a buyback or anything like that. That's really what needs to be true for them to hit these cash flow numbers that they are forecasting to deliver value to shareholders at the end of the day. And number three is deliberate capital allocation. So obviously, going back to the first point, making sure they're investing in 5G to be in a good spot there. But what they really need to do as well is strengthen their balance sheet. We're going to look at their balance sheet in a few minutes, but it is not too good, and it hasn't really been improving to the extent that lots of investors have wanted to see over the course of the last 1, 2, 3 years. So ensuring they get in a better net debt position, improving the quality of the dividend. They do pay a nice dividend today, but it almost comes into question, like, are they going to be able to maintain the 7% dividend? They have tons of debt. They're not really growing too much. So improving the credibility and the quality of that dividend to make sure it's sustainable is another top priority for the company. Going into their earnings here, on an absolute basis, they did just over $30 billion of revenue, which is about 1% growth versus the prior year. You can see they did 30.0 to 30.4. Adjusted EPS was about in line, slightly less than a year ago, but they had higher margin. EPS for these companies, there's so much depreciation and whatnot that funds from operation, similar to a REIT, is really how lots of investors scorecard the profitability of the company. So kind of take EPS with a grain of salt. And then cash from operations, free cash flow, $5.2 billion, really strong number. For some background on why the stock is as low as it's been in the year to date, they anticipated $16 billion of free cash flow this year. In the first 6 months, I think they delivered about 5. So lots of investors were saying they were no way going to hit 16 billion plus of free cash flow on the year. The company justified it by saying lots of costs and investments happened in the first half of the year, but really investors are looking to see stronger free cash flow numbers, and they delivered it in this third quarter. pretty much doubling their free cash flow on the year in Q3. So they're standing, I think, close to about 10 billion of free cash flow on the year now. And at the end of the day, in my opinion, that free cash flow number is the main reason that the stock is up 7-8% today. We're going to keep going through some of their report here and then just look at their balance sheet at the end. But I just wanted to say one of my favorite elements of these telecom companies are their mobility businesses. I think this is a really sticky business. Lots of people use their phone for all kinds of things. Usages of phones and smartphones are just expanding as well across the United States, which is where AT&T operates in. Average revenue per users have been decently ticking up over the last, let's call it medium term. So I think this is a great, stable, potentially growth business for them to offset their cable exposure and some of their other exposures that may not be as well positioned. So I really take a good look at the mobility results. On postpaid phone ads, it's great that they continue to have really strong net additions. Decelerating a bit though, which is a bit concerning, but their churn has still been pretty constant around that 70 to 80 basis points level. The churn is essentially the amount of people who opt out of their plan. So 99.2% of their customers stuck with them throughout the third quarter is the way to look at that. And as long as you're kind of over 99%, I think that's a pretty strong number. You can offset that 0.8% with new signups and promotions and immigration, things like that on their mobile business. They pretty much had all of their growth. It wasn't a lot of growth, but $400 million of growth for mobility, and there's $400 million of growth on the whole company. So all of the growth in the company came from mobility in the last quarter. Looking at some other portions of their earnings here, just quickly, they called out free cash flow of the quarter. We just went through at $5.2 billion. So they reiterated their $16 billion guidance for the year. And when you look at the stock price, it was at about $100 billion going into today. So that's about 6 times, 6.2, 6.3 times free cash flow on the year, which is, in my opinion, a pretty cheap valuation for a company that still has some solid businesses that they're operating. And that's really what they're looking to deliver for shareholders. If they actually can deliver another $6+ billion in Q4, it would be that $16+ billion on the year. And that really puts them in a good position to pay their dividend, start paying down some of their debt, probably not as aggressively as investors want to see, but at least start moving in the right direction there as they expand and invest in 5G at the same time. And the 5G's investments that they're making right now, huge CapEx investments, but they'll last 20, 30 years. So really, if they can get through this period while still slowly reducing their debt, paying that 7% dividend, and finishing the 5G investments for the most part, at least the mountainous ones, I think the company will be in a decent spot to deliver strong free cash flows for the medium term, and their stock price today doesn't really reflect that. And that's the reason that I actually do own some AT&T shares here. You can see here some of them bragging about some of their results. So 15 straight quarters with at least 200,000 fiber net adds. Mobility service revenue up about 4%. Once again, not big numbers, but at the end of the day, the company's trading as if all of their businesses are in free fall, and that's really not what we're seeing here. In terms of their balance sheet, this is something on this company specifically I look at really, really closely. So I'm going to go to their assets overall, just to make sure they didn't, take a lot of their free cash on hand and lower liabilities. But overall, total current assets are slightly up across the board. Other assets and whatnot to total assets are up as well. So no red flags on the asset front. Going to the liability, you can kind of see their long-term debt here went from $128.5 billion to $126.5 billion. So, not necessarily the progress that I want to see. I'd love to see them reduce this debt $5-10 billion year over year, not this $1 or $2 billion reductions. But, it's moving in the right direction. I can understand that they do still have the 5G investments they want to be making for the future of the business. And they really feel like they need to pay that dividend for shareholders and lots of their investor base who really rely on the dividend. So I understand why it's not going down as fast as I want it to. At least it's going down, which I like to see, especially on current liabilities here. We see them down from 56 to 51, which is good. Sometimes the longer term liabilities have lower fixed interest rates as part of them. So that's something to keep in mind too. Overall, still don't love where their balance sheet is, but it was a very slight improvement to where it has been in the longer term, let's call it medium term and last year, which I will take at this point. Looking at their EPS, which is really close to their funds from operation forecast. So it's about $2.50 a share, similar to what I said at the beginning of the analysis on AT&T. They're trading right around 6 times funds from operations and EPS. So definitely higher quality companies out there, but there's not many that are cheaper, that are this profitable still, in my opinion. So that's one of the reasons that AT&T's really just kind of got regraded a bit here today. If they can continue to provide this level of free cash flow, $15 to $20 billion of free cash flow a year, I think if they can do that consistently, their valuation will definitely get upgraded from this $110 billion level that they're trading at today. And in the meantime, to wait, I'm getting paid a 7% dividend on this one. So that's kind of the summary of AT&T. Moving on to Netflix, I actually do not own Netflix shares. I have in the past, and boy, do I wish I owned them yesterday, because they are up 16% today. Looking at this company longer term, they've been on an absolute tear, up 50% in the last 1 year, up 36% year to date. Even in the last 6 months, up 25%. You can see here they started dipping, $470 a share. So they went down about 30% before this recent rally here today. And their value is at about $180 billion here. So let's take a look at their earnings that they just posted. Looking at their overall results here, so just top line, looks like they had record revenue here of $8.5 billion for starters, 8% revenue growth year over year. Their EPS was close to $4 a share. Their global streaming paid memberships, this is the reason why the stock really went up today, was 247 million. So that's 9 million new users, essentially. Huge growth for a company and an industry that lots of investors feared were stagnating, was in decline, if anything, after the pandemic. And this is just showing that lots of their strategies around decoupling user accounts and making people pay for having more members on their account and whatnot has really paid off. They've got almost 10 million new users, and we can see it's really broad-based, which we'll look at in a minute. But this was a phenomenal number. They do not like investors trading on quarter-over-quarter paid membership results in terms of absolute customers. But at the end of the day, they still do. They really feel like that's a great metric for business success and sustainability of streaming as a platform in terms of the growth rate of new members joining. So that's really, I think, the reason why we saw the stock explode higher today. You can see total shares here. We'll talk more in a couple of minutes, but 450 million. So they did a modest share repurchase. Just not necessarily a big driver of shareholder value for the company. You can see here it goes up and down. I used to own the stock a couple years ago. I think they had about 445 million shares back then. So it just gets held a bit flat. They try to offset dilution. At least historically, that's what they've done. And they actually put a nice little forecast in for Q4, which I think may have also aided the sentiment by investors in addition to the global streaming membership numbers. They're going to have new record revenue of $8.7 billion, 10% year over year growth, net income of $1 billion as well. The EPS really does shift depending on when they have programming and when they have to spend money to build shows. So you really should more be looking at it on a 12-month forecast, which I think they're estimated forward looking to do close to $15 of EPS. So at the current stock price here, they're trading right around 26, 27 times forward earnings, let's call it. Going into the buy region. So this was what was really impressive here. And I'll call out a couple other things, but on buy region, paid memberships up almost 2 million paid memberships in United States and Canada. This was seen as a mature market. You can see here over the last 4 or 5 quarters, 73, 74, 74, 75, like it wasn't really growing much more than population growth and immigration. And then boom, they just got 2 million more subs. That's like 3-4% growth in a quarter. So that was really welcome. Their most profitable market going down Europe, Middle East, Africa, huge explosion, up 4 million users here. This has been a continual growth market. You can see in Q3 2022, so just a year ago, they had 73 million. Quarter over quarter, they've been growing pretty nicely, which was really just capped off with them 4 million new subscribers. So they're up more than 10 million paid subs in the last 12 months in Europe, Middle East, Africa. Really phenomenal results. Latin America here up nicely as well, over 1 million. And then Asia Pacific up 2 million. So really strong growth. Looking at one of the areas of weakness, which we'll talk as well in a few minutes, it really has been their ability to grow revenue per member. So this was a big quarter where they grew members a lot and grew revenue on an absolute basis behind that, but they didn't really have price mix help. You can see here, zero increase in the United States and Canada. Going to these other markets, take it with a bit of a grain of salt on the short term because there are foreign exchange considerations. The US dollar has been doing really well, but you can even see, excluding foreign exchange, they're still about flat, very modestly up in LATAM, and then in Asia Pacific actually down. So that's something that will probably be an increased focus, and they actually did announce some pricing initiatives, which we'll go over as well. At the end of the day, between pricing and between paid membership growth, this is like a case study for how to scale a global business. You can see here their operating margins just in the last 7 years. That is not that long of a time when you're thinking about a global push like this. In 2016, their operating margins were 4%, essentially flat. Their free cash flow was in the red. You can see year over year over year, operating margins have gone up almost 300 basis points a year. This was 500 basis points in 2020 when the pandemic took hold. But that's just phenomenal results. Seems like they've normalized a bit around 20, but with the scale of this business and their operating model, that could go higher from here. I could see it tick closer over maybe a longer period of time to 30 points. And then the free cash flow, you can see, was in the red, even getting higher in the red. During the pandemic, they turn into the green, and then kind of stabilized a bit. But so far this year, they're having a huge free cash flow number here, over $5 billion of free cash flow on this company. So they're really turning the page on profitability, both on a margin standpoint, but also just on an absolute free cash flow standpoint. And that free cash flow really enables you to invest in your business really aggressively, to really push the move to streaming. In addition to that, also lets you start returning capital to shareholders through share buybacks or heck, maybe a dividend one day. One thing that I also like to show, and they've been showing this for years as I've been looking at these reports with Netflix, is just how much on its infancy streaming still is and how much room it has to grow. And in addition to that, Netflix's position within kind of streaming and how much more opportunities they have as well. So this has gotten a lot more saturated over the last number of years, but you can see it's really interesting. YouTube actually gets more streaming time with Netflix, which isn't surprising. Hulu's actually a pretty big player. They're almost double the size of Disney Plus. Prime Video's big. Then you got some of these other ones here like Peacock, Paramount, Pluto. But overall, they don't really need to win share against these competitors to have a growing share of the overall pie, is I think what the message is here. 23% broadcast TV, 30% cable TV. That's over 50% of screen time in the United States. And as that gets lower and lower and lower, probably closer to 25%, streaming will naturally probably get closer to 50%. And they can just ride that wave of growth and really use that to increase their pricing power because people will be spending more time on their devices and on their, not their devices, but on their programming. So that's really kind of the case they're trying to lay out here. Wanted to look at their shares for a minute here. You can see they have been making some improvements. 9 months ending September 2022, they're just over 151 million. If we go to the last quarter here, they're at about 450 million. So once again, they're not really returning value to shareholders through buybacks yet. They did a bit of a buyback in the last quarter here. You can see they bought back about $1 million and change of their shares, so spent $400 million on that. But this is something that I think as they continue to turn stronger and stronger free cash flows, scale higher and higher, they've kind of talked about their ambitions to buy more shares back. And they really comment on that in this report here. They bought back 400 million, so about 1% of the company, or not 1% of the company, but over the last year, about 1% of the company, a million shares, so 0.3% of the company. Sorry for choking on that, in the last quarter. But they show here that they have a lot more cash in the business right now that they're going to be reinvesting in buybacks. So they bought back 1.2 million shares, which you just saw in Q1, and their plan is to continue to accelerate these buybacks over the course of 2023. So in the next 3-6 months, I think they said they may buy back a couple $1 billion worth of share, which may get their total share count from what we see here at 450, 441 on a basic standpoint, down about 4 or 5 million shares. So we may get from 450 on diluted to 445. Once again, that's right back where their diluted shares were a number of years ago when I was investing in the company. So this isn't necessarily like Apple or like Meta where they're buying back 2, 3, 4% of the company a year yet, but just them kind of allocating some capital here goes to show that this may be an area in the future that they do start to compound investor returns by allocating capital here if they don't see as many growth opportunities on their business naturally. Now, when we are looking at some of the growth on revenue per user here being really stagnant, they actually talked about that in their earnings call. So I wanted to play that quickly here for a minute and then just comment on it. So give me a second of your time.
Could you talk about the outlook for ARM in 24 and beyond?
ARM is average revenue per member for those who aren't familiar with kind of how they talk revenue per member on Netflix calls.
You guys want me to take that one?
Go ahead, Spence.
All right, you wound it up for me. Thanks, Jessica. So I would say just generally when we think about 24 and beyond, think about it as our revenue growth profile in general. And we talked about this recently. We expect a more balanced mix of membership and ARM growth in 24 and beyond 24. So just looking at 24 specifically, as Ted talked about, we expect to have a great slate to drive the business forward. And we expect to continue to do things like add extra members, grow our advertising revenue, as Greg discussed. And in addition, have some pricing adjustments. You saw that in our letter. All those things will drive ARM. So 23 was a pretty unusual year where essentially all of our growth came from member growth. And going forward, more broadly, not just 24 and beyond, we'll grow our business by continuing to kind of improve our service, increasing engagement, increasingly satisfying current and future members. And now that, as Greg discussed, we've got an account sharing solution, we have a more clear path to more deeply penetrate that big addressable market of, 500 million connected TV households.
So you kind of hear them talking about this year, they're acknowledging almost all of their growth came from user growth, which is kind of what we're seeing here with the huge increase in paid membership. Next year, they think it's going to be balanced. They think they're still going to grow new members, but they also think they're going to get higher revenue per member, whether that's through their advertising initiatives by having ad-supported models, which they're positioning to be as revenue accretive versus their all-in premium no-ad models, or whether it's through pricing, which they also announced on this earnings call and today that they plan on hiking prices in a lot of different countries here. So let's go through that. Premium plan, which offers Ultra HD streaming, will increase by $3 to $23 a month, while the basic plan will go up $2 to $12 a month. So it's like they're not increasing the ad-supported models, which makes me feel like they want more new subscribers to go into the ad-supported models to unlock that inventory so they can then start building bigger and bigger relationships with bigger advertisers with these very big lucrative contracts on the back end. They'll be less reliant on just subscriber revenue if they build out and scale the advertising side of that business. So that seems like that's part of their revenue growth per user strategy as well. So just to summarize Netflix here, looking at it on the day, keeps going up. Now 16.2% up at $402. Just overall thoughts, it seems like this company's really killing it on all ends. They demythed the sentiment that streaming was at its heyday during the pandemic and it's just going to kind of stagnate or decline in terms of users and willingness to pay. They demythed the risk of less discretionary spending, potentially meaning more people canceling streaming services, and more streaming services out there maybe impacting how many people want Netflix. So they've really positioned the narrative around Netflix as the go-to streaming service. Everyone who's in streaming for the most part has a Netflix account, and just because others will come on doesn't mean they'll take out their Netflix. They've also proven their pricing proposition and their value equation. Not many consumers have canceled their Netflix account. Actually, the contrary, more and more are joining, and they're acting on that strength. They're increasing prices. They're expanding their advertising supported model of their business to increase revenues in other ways that doesn't come directly out of a consumer's pocket. And they still see long tailwinds of growth across geographies, across pricing, etc. So this company is in a really strong spot right now, and I don't think investors fully realize it. It kind of caught lots of them off by surprise, and that's why we're seeing this value correction today. I still think forward-looking, that forward PE of 25 to 30 is a bit rich, but this is one of those companies that 5-10 years from now truly does have the opportunity to be a huge company. If they can get from 250 to 400 or 500 million paid members, as you know, the amount of people with TV move more and more over into streaming, and their ARPUs, or their average revenue per paid member around the world, get closer to the US. We saw that happen with Meta and their average revenue per users. We can really see a strong compounding of member growth paired with pricing growth, paired with a lot of efficiencies on the back end, and probably one of the biggest advertising businesses in the world 5-10 years from now. And all of that together will very likely equate to a company not worth 150 billion, but probably closer to $500 billion. So there is long-term potential, but you are paying up for it here. The strength did seem to catch investors by surprise. So leave it up to you guys if you guys think it's worth kind of holding on to Netflix for the long term. It's not a stock that I like trading in and out of, just because general sentiment on streaming subs and stuff like that can move this stock up or down 10% in a day. You see that over the last number of years, how volatile the stock's been. So not necessarily a game that I like to play. And while I can see the path forward, I also see some risks, lots of competition, and they're not really returning any value to shareholders today in terms of capital. So those are kinds of the businesses that I prefer investing in, whether it's share buybacks or whether it's dividends. So not one that I'm investing in, but I definitely realize the opportunity that this stock has in front of it. So those are the two stocks that are up huge today. Netflix at 16%, AT&T around 8% here. If you like this kind of content, be sure to subscribe to the channel. Give this video a big like if you made it to the end. It really does help me with the YouTube algorithm, so I do really appreciate it a lot to get these videos out to more people. And I'll see you guys in the next one. Thanks.